What happens when your super fund makes a wrong move?
When we talk about private markets, all we really know at the moment is that they're growing very rapidly in Australia, and we'd like to understand them better. What we're really worried about there is opacity.
What happened with ART is not an issue against the asset class, nor is it an issue against ART itself. It just is a challenge going forward when you manage illiquid assets.
Hello, I'm Rebecca Jones and welcome to the Bloomberg Australia podcast. A big slice of our retirement savings is being poured into what's known as the private market. So what is the private market? Well, for one, these investments are often opaque, hard to value and, quite frankly, they're pretty tricky to keep track of. In fact, if you wanted to know what many of these assets are worth or even where they are, it's something you'd struggle to find out. So today I'm talking to Melbourne-based reporter Rich Henderson to explore what happens when some of those big bets in the private market go bad and what the fallout means for our super balances. Rich, welcome back.
Thank you very much.
First of all, private market, it's a really broad term, right? Can you explain what kind of investments these assets are exactly and, on average, how much of Australia's retirement savings are being invested in them?
Yes, good question. So basically, this is anything that is unlisted, and that is anything that doesn't trade on a stock exchange, basically, or some type of exchange. Bonds can trade on an exchange as well. So it's anything from private equity you might access through a private equity fund, or infrastructure, or real estate. It's anything that fits that bucket, something that you can't trade, like you can trade stocks, which you can do now from your phone in a few minutes. These things you might need specialist funds or brokers to actually transact. And that means they're less liquid. And liquidity, all that means is, the ease of buying or selling. So it's a little less easy to buy and sell these assets. And so investors demand what they call in the industry an illiquidity premium, the little extra reward you get in investment returns for owning something that you can't buy and sell very quickly. And keep in mind, private markets can make up, say, 20 to 25% of a typical super fund's portfolio. So it's not an insignificant sum.
As you just mentioned then, real estate is a big part of these markets. Bloomberg News broke a story just last week which gave us a really stark example of what happens when a big unlisted property investment goes horribly wrong. And this time it happened to Australian Retirement Trust, which is the second biggest pension fund in Australia. Tell us about what happened there, Rich.
So ART purchased a property in the state of Washington, just outside of Seattle. And at the time, at the start of 2020, it seemed like a great deal. The towers were full of Microsoft employees. That was the anchor tenant. And unfortunately, we had a pandemic.
Yeah, I was going to say, timing.
Yes. The hybrid work movement completely changed how large companies, especially those in tech where you don't really physically need to be there. It's not like you're a waiter in a cafe or something, or on a production line. Obviously, more people working from home, less requirement for physical office space. Well, the value of that asset has declined, and pretty sharply, I think roughly half, if we're to speak in broad terms. And so ART appear to have made the decision to walk away from that asset. It was partly financed with a loan, and essentially through documents we've accessed through the Bloomberg terminal, we can see that ART is defaulting on that loan, which is an apparent move to walk away from that asset because of the sharp drop in value.
Gosh, so this story was truly an international work for Bloomberg, involving bureaus across Los Angeles, here in Melbourne, and of course in Seattle. Anna Edgerton, our Seattle bureau chief, actually went down to check out this office tower, which, as you mentioned, is just outside of the Seattle business district. This is what she found. Here's Anna now.
When we confirmed that ART was going to walk away from these two buildings, I went over to Bellevue to get a feel for this Bravern development. The office towers were almost totally empty. In the first Bravern building, the elevators appeared to be turned off. There are 2 restaurants in the lobby, a high-end steakhouse that wasn't even open for the lunchtime hour, and a highly acclaimed Chinese restaurant that only had 1 table occupied at 1 p.m. on a Thursday. I spoke with the manager, and he said there was a flurry of interest when that location first opened in March after Microsoft had already vacated the building, but business has been pretty slow since then. In the lobby of the second Bravern tower, it was also empty, and the Neiman Marcus that was on the ground level was closed. On the same block, there's an apartment building and 2 levels of outdoor retail space filled with luxury stores like Prada, Gucci, Louis Vuitton. There's a high-end jewelry store. There were some people milling around on a Thursday afternoon, but it certainly wasn't bustling. The manager of a tea shop told me that there is some business from residents of the apartments, but she has really seen a decline in foot traffic without Microsoft workers walking by on their way to office buildings. She said she's still optimistic for Bellevue more broadly because it does attract a lot of wealth, and she's betting on the holiday shopping season to help them get by for now.
So there you have it. Something that was a sure bet of 2020 is now resembling more of a ghost town, I guess. Which I guess also shows that fortunes can turn around pretty quickly. Rich, is this part of the reason why these harder to sell assets are generally considered more risky than the likes of, stocks and things that are publicly listed on exchanges where we can see the values literally change?
Yeah, definitely. The liquidity of, say, publicly traded stocks like Apple or Nvidia, you can really get a sense of their valuation. You know exactly what profits they're generating because they have to disclose it. That's a requirement of being a public company. With a kind of office tower like this, it's harder. It's quite idiosyncratic. You have here Microsoft, which is a great business to be as a tenant, one would imagine, very stable, very large. But it also put in its own money to refurbish the buildings. And so, when that tenant leaves, it's hard to, be able to model or factor in getting a replacement tenant and then what kind of income that may generate, what kind of value that building therefore may have relative to something like a stock that you can see on your phone.
And when we come back, we're not the only ones paying attention here. Why Australia's super funds have been put on notice by our regulator about their growing piles of private assets. You're listening to the Bloomberg Australia podcast. Welcome back to the Bloomberg Australia podcast. You're here with me, Rebecca Jones, and I'm talking to reporter Rich Henderson about the massive chunks of our retirement savings invested in private markets and what happens when these investments go wrong, like they did recently for Australian Retirement Trust that's defaulting on a loan it used to buy a huge office complex outside of Seattle, meaning they're essentially writing off the asset. But Rich, this is not the first time this has happened in history, is it? Now, Aussie Super also got burnt by more than $1 billion last year thanks to a failed private equity investment. What does all of this tell us broadly about the risks that Australian funds are taking overseas with our money?
Yeah, so it really speaks to the risk within the risk-return paradigm. And as large super funds, as the system as a whole is getting more assets, it's needing to diversify those assets beyond Australia. Essentially, the system has outgrown Australia. And so because of that, it needs to invest more overseas. These funds need to invest into listed markets like the US stock market, but also unlisted markets. And so that's why the money is going to these places. And, you do need to have the soured bets. That's all part of the investment kind of ecosystem. And it's that risk element that makes these attractive because higher risk, really does bring higher returns. And so, this isn't a zero risk investment or a sector. And so these losses essentially are part and parcel of the risks that Australian funds are having to take. many of them will be hugely successful, but there will also be these examples of what look like failures.
Risk, of course, is part of any game of investment, right? But what I think is particularly interesting is how ASIC, our regulator, is becoming increasingly nervous about these private assets, especially when it does come to their valuations. Rich, can you tell me about the report that they released last week after reviewing 60-odd funds, financial reports? Did they like what they saw?
They were very cautious on the whole topic, really, and essentially they're asking investors and the consultants that help audit their financials, they're asking them to kick the tires. They're saying, we want you guys to ask more questions, to be really sure of some of the valuations you're receiving from the external investment managers who oversee these assets. And it's a very dense, quite tricky topic because a lot of these assets are very different. A lot of the methodologies can differ. A lot of the frequency on those valuations can differ. And because some of them are super idiosyncratic, you as an external fund manager working for an Australian super or an ART, you might have to look at peer transactions, transactions of assets that are sort of like the data center you own or the office tower you own and say, well, that sold for that price, so I reckon ours is around this price. So it's quite hard to come up with a valuation methodology. But basically the regulator is saying, because you guys are investing more in these things, you really have to understand them better.
Why is it, though, so important that we know how much these investments are worth or, indeed how much they've dropped when they are such a relatively small portion of these big super funds portfolio?
Yeah, for some it can be a blip, these kind of, missteps, if we should call it that. But really the regulator wants confidence, so super fund members are confident in the overall system that these funds are properly investing this money. They are, stewards of this capital on behalf of super fund members. And so that's really what's behind this. And I think they're also seeing this growth in Australian super funds investing in these type of assets, and they're saying, okay, we need to really be thoughtful about how we oversee this, and we want to be ahead of any big, blow-ups, because these are so illiquid. Sometimes the valuations you're getting, this is a paper valuation. When you really need to sell it in a stressed market scenario, you really need to get rid of that office tower, you might be having to stomach some really big losses. And so I think the regulator's really trying to make funds and the general public more aware of this and to make those valuations super robust.
And yet for all of this, the funds are still under pressure to deliver decent returns. At the end of the day, this is our retirement savings money. But they can't just park that, $4.3 trillion odd dollars into term deposits, can they? Is there any way to avoid investing in private assets entirely, or is that just not possible anymore?
I think it's possible, but it's probably not desirable from a diversification point of view, and really wanting that geographic diversification and also diversification across asset classes. So I think on the flip side, the super funds would probably be criticized for not putting, their money into, private equity, private credit, infrastructure, if they weren't. So it's really about, doing the best for the super fund members, really getting a nice diversified asset allocation and making sure you understand it. And
maybe meditate a little bit on what the word risk really means.
Yes, and cross your fingers and hope it, goes up. Yeah.
Rich, thanks so much for joining me.
Thank you very much.
If you found today's conversation insightful, be sure to follow the Bloomberg Australia podcast wherever you listen and check for more reading on Australia's $4 trillion super industry, including the latest reporting from Richard Henderson on Bloomberg.com. Today's episode was recorded on the traditional lands of the Wurundjeri people. It was produced by Paul Allen and edited by Chris Burke and Ainsley Chandler. I'm Rebecca Jones, and I'll see you next week.